Good morning. I'm Keith Fitz-Gerald. Welcome to the Five with Fitz, and thank you for your patience while I try to soundproof my new room. Haven't gotten around to it quite yet, so hopefully this microphone will be a little bit better than the last couple days. It's a work in progress. Anyway, let's get right to it. You know, I think it's an imagine that. Good news is actually good news, and stocks are rising after a ceasefire extension and strong earnings. What do you know? The S&P 500 is, of course, tracking 7120, while the NASDAQ is now trading at roughly 24,489, which means the former is up something like 9.5% off recent lows, and the latter is roughly 17.8% off recent lows. Many of the names that we talk about regularly have done even better, of course, and that's the great part. Now, I have no idea if that'll continue, but that's really a moot point. I've told you time and again that you cannot hope to be up if you're not investing when the chips are down. And frankly, I hope you've been doing exactly that, investing when the chips are down. Why? Because there's now a huge pile of money on the sidelines held by investors who thought they were being smart by stepping aside, but who are now coming to terms with the fact that they're getting left behind yet again. I mean, oh boy, here we go. Anyway, remember, investing isn't rocket science despite the fact that many people want to make it that way. The path to profits is almost always to A, buy the best, ignore the rest, and B, buy when others can't resist selling and sell when others can't resist buying, right? That's the game book. It's my playbook, and it's worked for a long time. So number one today, it's a $40 trillion opportunity, and most investors are still missing it. Now, I sat down for a wonderful conversation with my good friend, Scott the Cow Guy Shalvey. Great colleague, super brilliant guy. And he's so named because of the colorful old school pit jackets that he wears on air. And that's really something special. Anyway, we spoke about what I believe to be a $40 trillion opportunity in robotics, why space could be bigger and sooner than anybody expects, and how companies like Tesla and, of course, Palantir fit into the much larger shift that is already underway. You can watch that video elsewhere on my channel, and I hope you do. Hopefully, you've got a slice of the pie already, because I can guarantee you that somebody else most certainly does if you don't. Robotics isn't a someday story like Wall Street seems to think or wants you to believe. So they can snap up the bargains before you realize what's happening. That's how the game's played. The convergence of AI, cheap sensors, and next generation manufacturing is compressing what used to be decade-long adoption curves into years, months even, sometimes weeks. Now, something we've talked about many, many times over. Investors who are buying companies building the picks and shovels for this shift and the ones deploying the machines stand to capture returns that many people don't yet understand and haven't even remotely begun to price in, which is the exciting part. For example, Tesla and Palantir get the headlines, but the real opportunity runs far deeper than just those two ticker symbols. Those folks who come out ahead or tend to come out ahead will be the ones who understand the full supply chain we've talked about. Hardware, software, data infrastructure, not just the names they see on TV, and those who invest accordingly. In what I call the sixth wave. Now, that's an opportunity that is unprecedented in human history. You can look at this image in the written version of 5 with Fitz. Now, if you haven't sized up your exposure and bargains at hand, now is a good time to ask yourself, why not? Here's an investing tip in this department. History is very clear. The biggest fortunes tend to be made by investors who recognize tidal shifts early and who get their money there first. Number two, first there were the pigs, now the biffs. Very few people today recall the pigs, which, yes, was pronounced exactly the way it looks back in 2011 during the European sovereign debt crisis. That not-so-nice acronym stood for Portugal, Ireland, Italy, Greece, and Spain, which were the so-called problem children of their time because of their shoddy banking practices, and those things threatened to take down global markets. Minor inconvenience. Anyway, I said during an appearance on Varney & Company that it would be $1 trillion problem long before most picked up on it, and you know how that ended. So I'd be remiss if I didn't mention this. Now there are the BIFs, Britain, Italy, and France, where credit spreads look to be setting up a repeat. I hope not, but I'd just be terribly remiss not to point out what's happening. Bond investors are exacting a heavy price from 3 of Europe's largest economies, all of which are struggling with a credibility crisis as the Iranian conflict has thrust government borrowing back into the spotlight, specifically sovereign debt. Now, the reason this matters is that when investors, meaning bond buyers, lend, they are increasingly concerned about A, where their money is being spent in governments they don't trust, and B, whether they'll get it back via any form of repayment, if at all. Now, I'll add the US to that list, but that's just me and a topic for another time. Anywho, what you want to think about is that you can see that in the spreads, meaning the gap between what Germany pays, for example, to borrow, and what riskier countries like Britain, Italy, and France now pay to borrow, the BIFs, right? Many investors think, so what? This won't impact me. That's a mistake and a half. We are all likely to experience higher volatility, tighter credit, and renewed pressure on stocks if sovereign debt fears continue to build. That is why I suggest investing in cash generating, dividend paying companies with strong balance sheets and pricing power. Oh, and something called a positive TSY, true shareholder yield, which brings up an interesting related point. Most investors are still fighting the last war, so to speak, meaning that they're chasing the highest yields they can find and wondering why their income portfolio keeps disappointing them. Well, TSY flips that script around. It's not about what a company pays you today, but it is very much about what it's worth paying you tomorrow. Now, that's the difference between regular income and growing income. And it's why the math almost always favors TSY over yield alone. For example, Chevron's listed yield, a company I talk about a lot, shows up on most public sites at 3.83%, but the company's TSY is nearly 4.94%. People want to know why I prefer that over the other energy majors? Well, now you know. Investing tip in this department, my research shows that companies with positive TSY outperform those simply offering yield, which is what most investors chase, which is why you want to own them, especially if you're a dividend investor, and especially today. And by the way, the OBA family knows all about TSY and has for years, which is why they're enjoying the benefits associated with owning them. But hey, if you're still good with chasing high yielders the old-fashioned way, only to have them cut their dividends at the worst possible moment, I can't do a whole heck of a lot about that. Number 3, Apple just telegraphed its next move. Do not miss it. Now, I've long maintained that there's a good argument to be made that Apple's actually already won the AI wars, something Wall Street analysts cannot fathom, and neither can legions of analysts and investors who have swallowed the bait that Apple's behind, hook, line, and sinker. And the fact that Apple just promoted Johnny Srouji, the company's silicon lead, to the new role of chief hardware officer at the same time that John Ternus, a product expert, was named next CEO lends credence to my argument. So here's what I think everybody's missing. Well, OpenAI, Google, Microsoft, and the rest of the AI crowd have been spending trillions of dollars building an ever bigger cloud model. Apple's been quietly doing what it does best, something completely different. Pushing AI down to the device level where your data never leaves your hands. Now, the big models can't do this yet because the chips aren't powerful enough. Apple's been building toward exactly that for years with its custom silicon. The M series, the A series, the neural engine, and elevating Srouji tells me that where the company's center of gravity is likely headed. Now, my POV is this. Apple is going to release something within the next year or two that catches the rest of the AI trade, so to speak, completely flat-footed. Not because they outspent everybody, but because, well, everybody else was building bigger data centers. Apple was building something nobody else can easily copy. A billion device edge computing network already in people's pockets and their hands. Now, on device, AI solves two things that customers actually want: privacy and speed. No cloud round trip, no data exposure. Your data is your data, it's private. Imagine what happens when Apple flips that switch across 2.5 billion active devices. The entire installed base and billions of consumers becomes the moat almost overnight. Now, Apple isn't the flashiest AI story right now, which is precisely why it's worth paying attention as an investor. If you've been underweight Apple waiting for a clear catalyst or have fallen prey to the blizzard of crap, highly technical investing term that passes for actual research, do yourself a favor. A new CEO and a silicon chief elevation in the same breath is worth taking seriously, especially since almost nobody else sees this coming that I'm aware of. So investing tip, my experience in the past 40 years is that by the time everybody else agrees with something and it being obvious, the opportunity's already gone. Just saying, again, invest early. Number 4, Palantir from the battlefield to the breadbasket. Well, Palantir just struck a $300 million contract with the U.S. Department of Agriculture, the USDA, to manage farmland security as geopolitical risks. Iranian conflict, trade war with China, disrupted shipping lanes, all those things threaten the global food supply chains. Now, apparently, the new program broke records for online signups within 62 minutes of opening. That tells you something. And sadly, the vast majority of investors and traders will file this under another government contract and move on. Or they'll fall prey to more baloney from what I call the short crew about how Palantir isn't a real business. It's a big mistake either way. Ask yourself why China has been quietly buying U.S. farmland for years, and that nagging feeling in the back of your brain isn't random. Washington is very definitely spooked, and the USDA just handed Palantir the keys to fixing this problem using the same AI-powered data infrastructure that it already runs for U.S. military, including, among other things, the Maven Smart System platform used in Iran. Now, the way I see it, here's the opportunity. Palantir is being trusted with the food supply of one of the single most powerful nations on earth because the stuff we put in our mouth isn't optional. Now, I've been bullish, of course, as you know, on Palantir since it was trading in the single digits and long before Wall Street could even spell it. What? I got more than once, and yet here we are. Anyway, I think there's a long way to go yet, so I'm going to stay in the game. Keith's investing tip. The key to owning great stocks like Palantir is not getting scared out of them. Meanwhile, Carpus Maximus, history suggests there are 10 to 15 Palantirs out there in various stages of maturity, which is why it's your job as an investor to find them. And the OVA already has a few of those on deck in case you're wondering and would like to join in on the hunt. You know where to find me if that's of interest, and it's right here. All right, number 5, what to do when you don't know what to do. I hear it all the time, especially lately. Keith, I'm worried. I don't know what to do. Is it safe to stay invested? How do I get started? Is real estate safe? Which companies should I buy? What ETFs are best? You're not alone if you're asking, and if you're one of those who is wondering. Not by a long shot, my friends. That's why my dear friend and personal financial expert, the incomparable Susie Orman, is holding a free webinar on Thursday, April 23rd, 2026 at 6 p.m. Eastern, 3 p.m. Pacific to answer those questions and more. And I want you to listen. Susie has spent 4 decades helping smart people build and protect their financial future while avoiding costly mistakes that can set them back forever. You don't need to be rich to get it right, says Susie, but you absolutely do need to be prepared. And I agree with that statement 100%. So reserve your spot now. I already did. My bride and I will be listening, and I hope you will be too. Here's today's bottom line. Investing is a journey. First, you learn how to lose. Second, you learn how to learn. And third, this is the fun part, you begin to make money using what you've learned by losing. As always, make it a great day. Thanks for watching. You got this, I promise. And I'll see you again soon. Cheers.